Good afternoon, everybody, and welcome to this edition of our weekly market analysis session for Feb 6. My name is Carl Capelingwell. I'm the market analyst over here at ThinkMarkets Australia, and it's a pleasure to be with you as we delve into all of the key events from last week and have a look to the week ahead. We'll kick off with our customary look at crypto this week. We'll look at Bitcoin, Ethereum, Avalanche, and Fantom. Then we'll have a look at the major US stock indices and a bunch of ASX technical and fundamental indicators in the commodities, all the majors from the metals and energies. We'll have a look at fixed interest, particularly US and AU bonds, and then on the forex side of things, see what the US and Australian dollars are doing. Obviously, we'll have our look at the key macro data events from the week and then our look to the calendar for next week. Let's kick off with crypto first. And as you can see there in the table, pretty good week for crypto. Could have been better. On the weekend, we've seen a bit of a pullback by anywhere between sort of 2% on the majors, maybe a little bit more on some of the altcoins. This is a Saturday snapshot. I have to take that snapshot somewhere because crypto trades 24/7, of course. Look, the key themes there, reasonably good week, a great looking month where most crypto's up around about 20 to 30%, but we can see just how far they've fallen from those highs and just how far they've got to go to get back to them. In terms of overall fear and greed, we're at 58. That's up from last week's 55 and well up from last month's 26. Wouldn't classify this as major, but Cathie Wood coming out and reaffirming her 2030 base case for Bitcoin at $500,000. You can see on screen it's trading around $20,000, so that would be a massive increase over the next 7 years. That's her base case. Her bull case is for a $1 million target. She said it is the ultimate defensive hedge, ultimate insurance policy against wealth confiscation. So Cathie Wood obviously still very confident on the prospects for Bitcoin. And she also had positive comments about Ethereum as well, which we'll look at next. Just in terms of the technicals, we can see that the short-term trend still skewed to the upside. That's that light green zone down here. That's nice to see. Long-term trend is trying to change. That's a positive as well. We're going through that traffic light system. So obviously pink or dark pink means stay out if you're a bull. You can see how accurate that has been on the Bitcoin chart. And then when we go to amber, it means, look, we're not as bad, but we're not yet, green is go, full steam ahead. So if you do see the right price action and the right candles, look, you can start to take some tentative longs. And I do think, particularly this rally here through Jan, very, very impressive. In fact, we haven't given a whole lot of that back through late Jan and the start of Feb, I think is also very encouraging. I'm going to say if we can stay above this long-term trend zone, which in the past has acted as a supply area, now potentially if it can act as a demand area, as an area of support, I think we're okay. So let's say as long as we don't print, say, below 20,000, dare I say, the next Bitcoin bull market has begun or has the ability to continue. But that is a big, big if. Looking at Ethereum, if we kind of try and find that same level, let's call it 1,400. We don't want to see it trade below 1,400. Something really bad would have happened to get us down there. Otherwise, we're being supported by that long-term trend zone. That's, as I said, the orange zone, and the short-term trend is still up. We are seeing significant compression between 1,500 and about 1,680, and 1,680 is that key level now. If we can close above that, hardly what you'd call clear air. So there's a potential supply point there at 1,790, and probably a two handle is the ultimate target of this next phase. Now, looking outside of the two majors there, Avalanche obviously had that big tie up with AWS, Amazon's cloud computing arm. That's the main reasons why it's rallied. It looks a little bit similar to the two majors, but I like the fact that it hasn't pulled back. I think there's more in this run. It's just a matter of being patient and waiting until we can develop some white candles here to draw in some of that FOMO crowd. In particular, I'll be looking for a close above 2080 to add some risk on this. I don't think you necessarily need to add some risk right now. I think we do want to see some positive momentum before going down that path. One, I do think you can or could have added some risk on. I did discuss this in the media on Monday. I said to buy it as just under 50. Look, hit 65, which was what I said was an intermediate target. If we can close above that, I did say you could add some more risk, and I would reiterate that now, but we're in a little bit of a pullback phase here. Nothing goes up in a straight line. I'll be looking for some demand candles to kick in, sort of that mid 50s, so around 55. You see the white candles and the lower shadows kick in there. You could probably add a little risk and then think about following that initial idea of adding another batch of risk above, say, 65, 55 and a close above that. But otherwise, you can see the short-term trend has turned higher. That's great. Long-term trend also turning. And in terms of price action candles, it is really one of the better, if not the best looking cryptos out there. Moving on to stocks. Now we see the volatility index, that's the main chart, is trending down. That's good for equities because the best bits of the bull market tend to occur when volatility is very low. Looking in Asia, Hang Seng down 4.5%. I didn't follow that story this week, apologies. But looking at the Shanghai Composite, which was pretty flat, both markets first week back after their holidays, probably not going to read too much into it. Nikkei was 0.5% higher. Looking in the US, it appears to be a bit of a mixed bag, but not necessarily in a bad way. Dow Jones was down. That's our value trade. A very defensive group of stocks in that index. So we're looking at 30 of the biggest blue chip, most liquid stocks in the US. They're the stocks that investors tend to go to when they're nervous about future economic prospects. When they're nervous about future economic prospects, they tend to avoid stocks like NASDAQ stocks. And that's because many NASDAQ stocks are pre-earnings. They are not yet earning money, or they may never earn money. And many of them rely on debt funding. So when you look at what happened in 2022, when interest rates shot through the roof and risk appetites shrank, that is not good for them. But we are seeing a resurgence here in the NASDAQ Composite at the expense in many ways of the Dow. And that, I think, is positive for what we say is risk on sentiment, and you need risk on sentiment to blow the next bull market bubble. Then in Europe, we're generally 1% to 2% higher. Having a look at global indices here, we've got the Shanghai Composite, very important for Australia, also very important for the global growth story. What we're looking at mainly here is the turn potentially in that long-term trend. It's still early days. We're still amber, we're not green, but we are seeing the prices for now stabilize above that long-term trend zone, which you can see just how well it acted on the way down as an area of what I call dynamic resistance. So we've got support and resistance, but typically you're drawing support and resistance points on charts at major peaks and major troughs. And I say they are static, okay? They're static because they don't move. But I do feel there is another form of support and resistance in the market that does move and meld with, investors' risk appetite. And we'd see these trend ribbons that I've identified work very, very well, both in the short term, you see the ones that just move a little bit faster, and in the long term. So the theory here is that obviously when we are in the red zone, they tend to resist upside price action, and when we are amber or green, they tend to support. So as long as we stay above that long-term orange zone, we're okay. Short-term trend is supportive as well. So we're just looking at potential factors here which could derail this running thesis I'm going to have through today's presentation, that potentially markets stand to have a pretty good 2023 despite all of the worries that are out there. Dow Jones Industrial Average, we can see that's looking pretty flat but not terrible. So we can push above, say, 34,343, 34,713. It's going to start to look very, very good indeed to go back up and challenge those highs from around 37,000. That would be supportive of the move to a bull market thesis, as is the S&P 500. Still early days again. This is the common story here. Long-term trends are orange. They're not green, but they are starting to support. You can see here, right, this little pullback in here, how prices were supported by the long-term trend zone. The other thing to note is just how good the price action is. Lots of high peaks and higher troughs, and plenty of white candles in here as well, indicating there's lots of demand just ebbing into the system. Friday's candle, a little bit disturbing. Let's go to the NASDAQ, because I think this is more illustrative of just how disturbing Friday's candle was. Obviously, Thursday's close was close to exemplary. I mean, amazing run up through here on the back of the Federal Reserve meeting and Jerome Powell's speech. We'll talk about that later. But then Friday, we had those super, super hot non-farm payrolls, which switched the market's mind again about the future path of interest rate increases in the US. So we saw this big drop down. Look at Thursday's close down to Friday's open, and then in this sort of bullish nature that we've had, this momentum came back in to push prices back up to positive on the day, and then we wiped out towards the end. And it's the wipeout towards the end that concerns me. And I think it probably will facilitate a further round of profit taking, and we could see prices move back into this orange zone where If this idea that we are moving into a new bull market, early stages, then this area here should be supportive of prices. You can see again how it's resisted prices dynamically throughout this bear market. If this area turns into support, ladies and gentlemen, then we are in the new bull market. Until then, watching candles, white candles in here, fantastic. Lower shadows in here, fantastic. Black candles in here, disturbing. Upper shadows in here, disturbing. So eyes peeled. From here, Russell 2000, if we look at actually Friday's candle wasn't that bad at all. And I'm taking some heart in that candle because, Russell 2000, another big ball of risk like the NASDAQ. We're talking about the smaller 2000 stocks that Russell tracks. And that wasn't too bad. Actually didn't take out Thursday's low. So there are some good signs out there. Price action there, candles there, very good. Let's have a look at commodities now, switching to metals first. Not a great week for metals. Generally, they were lower. You can see copper, a fairly sharp pullback. We'll see that chart in a second. Down about 3% there on the London Metals Exchange, about 4.5% in the New York price. Iron ore was a little bit mixed. Chart on screen. Still holding this short-term uptrend really well, although it is being challenged with a black candle there last session. And the long-term trend, much like we've talked about on many of the other charts today, is amber and starting to turn higher. We will need to see that act as an area of support. I would say, look, as long as we don't trade beneath 110, this new uptrend phase is very much intact. Looking at copper now, had said over the last couple of weeks that we're getting a little bit tired on this chart. Probably should expect a pullback, and that is what we've seen, unfortunately, for the copper bulls. But I don't think all is lost. The candles aren't great, don't get me wrong. These are not a great cluster of candles, particularly this lower shadow here and then black, not great. But there is demand. That's the silver lining. I think $4 US pound is the key area. If we see a bunch of white candles in here, if we see a bunch of lower shadows, we are setting up to use this as a trampoline, a support base to continue what could be the new bull market here in copper. Upside targets still capped, however, around that 458 level. But watch this area. Really, it's around 4, maybe as high as 404, maybe as low as 393. The candles there will be crucial. Having a look at nickel. So I guess we're looking at copper, we're looking at nickel, we're looking at iron ore, we're looking at basically global growth expectations down the track. Okay, so next 12 to 18 months. And we've had a lot of bad news on that. Let's put the news aside and let's see what traders are actually doing. Are they buying these key industrial metals? Well, nickel is looking a little bit neutral, but short-term trend is up. And I say neutral because if we look at the last 2 or 3 peaks, they are starting to form within a range. If we go back to, say, the 4th peak, and the troughs as well. Okay, so we do appear to be range bound between, say, 26,000 and 31,000, but the long-term trend gradually up. And you see we're sort of grinding towards the upside. So I don't think there's anything so sinister in there to suggest that we're going to see a big cliff in global growth that many of the bears are predicting. Have a look at lithium carbonate. Now, it's one of the 2 key lithium contracts out there. We can see that it does continue to pull back. If things are going to turn down, it tends to turn down first. And we are trading now below 440,000 yuan per ton. And that's getting pretty close there to the dip in April, May last year. Now, you can refine your lithium carbonate into lithium hydroxide, and therefore this tends to trade at a premium on a like-for-like basis. And it is holding up better, but we do see a bit of a moderation, let's say, in this long-term uptrend, which ultimately has been flat now for the better part of a year. Let's switch gears and head to gold, one of the sort of key macro, I wouldn't call it an asset class in itself, but key macro themes or indicators. Gold tends to do well when we've got out of control inflation and or the US dollar is falling and or interest rates are very low. And many of those things are linked together. So gold was doing well on the back of generally declining interest rates with inflation numbers easing, the view that the Fed is very close to a peak and that there will be rate cuts in the not too distant future. So rates had come down, that was helping gold. Because of the lowering of rates, the US dollar had been weakening, and that had also been helping gold. And during the week, if you look at Wednesday's candle, this one here, that's just after the Federal Reserve meeting, gold was looking hunky-dory. I honestly hand on my heart would have said it was primed for a move to 2000 based upon that white candle there on Wednesday. I didn't see the Thursday, Friday coming. Honestly, I didn't. But I don't think the market did either. Such as the severity of this move, it indicates the market was not positioned for what happened on Friday with those jobs numbers. We'll talk about that in a second. But what it does create here on the gold chart is if you blend these two candles together, that is, combine the open, high, low, close into a single candle, it is a big black candle. It is a big black candle. In fact, probably bigger than any two candle blend on screen. And when you do see these big black candles, here's one here, and you've got a cluster here, it's generally not good. It's generally the sign that the market has been shocked, and now that many traders are on the wrong side of this trade, and they'll be looking over the next few sessions, week to 2 weeks, to reverse that trade. And then often you get this double top, this lower peak. So here's your major supply event here at 2070, and then you see traders who've changed their mind starting to get out. So if we see gold, it could rally from here. There's no reason why it can't over the next few sessions rally, maybe back into a 1900, maybe back into a 920. But if you see that second supply event, then gold is going to roll over. So what I tend to suggest here for clients is that when you see that major supply event, you take some money off the table. We've still got a nice short-term uptrend on gold. It has been battered. The long-term trend has switched to up. So I don't think you necessarily throw the baby out with the bathwater, although that is an option because it's not great what's happened. But I do feel that even though it feels like it's gone down so much, it needs to bounce, the most sensible option is to take at least partial profits here. And I often suggest, roughly a third of your position off the table there. And that might extrapolate out to your gold stocks. However, we have had a bid from Newmont Mining, which is certainly the top 5, if not the biggest gold producer by annual production, for our own Newcrest mining over here in CM. And if you work out it's an all scrip offer at 0.38 of a Newmont share for your Newcrest shares, and then back that through the currency rates, it works out to be about 27.40, give or take, for Newcrest shares, which are trading around 22.50 before the offer. So today's pop, it makes it tricky. It might give you an opportunity, maybe that's fortunate what's happened, to enact that 1/3 trim at better prices on some of your gold stocks, because I think the message there in the gold price isn't great. Okay, I need to keep moving because I'm way behind time here. Energy, wow, down nearly 8% on your crudes, and then 23%, not a misprint, massive sell-off continued in natural gas. We'll look at those charts in a second. Crude on screen, and just for me, just reinforcing, it had a chance here. It had a chance. It was looking half decent, double bottom, higher bottom, maybe to poke through that long-term trend zone and turn it. But no, it's failed. And I'd say if we crack at 70.80, we're going to go back and test 62.43. I think that's starting to shape up as a really reliable trend here to the downside for traders. Aussie dollar was down. We saw obviously gold get whacked. The Aussie dollar got whacked as well because the US dollar rallied, and US bond yields heading back up, reversing course really for the week. You can see for the month, they're down substantially, and that was because of the CPI data and Jerome Powell's somewhat dovish comments, but the non-farm payrolls really turned things around. Okay, we'll get to some of that stuff. We'll just quickly do the energy commodities first. So we've got coke and coal. They look fine. So your Stanmore Resources, your Coronados, I think they're okay. I'm not as confident about the thermal coal companies. Looking at those charts, they do look like a trim, and you can see how much thermal coal prices have come off. Many people will argue, you're going to get a couple of years of great dividends, but you might lose some of that back in your capital gains. That trend looks to have turned. Not yet turning back to the upside, natural gas futures in the EU, but the trend there certainly set to the downside. We didn't get that energy Armageddon that many traders were expecting in the Northern Hemisphere winter. They did manage to get their stockpiles well in hand, and then we had seasonally warmer weather, at least to kick us off. Looking at the NYMEX natural gas, this trades in New York. It continues to fall. We saw obviously that large weekly decline. We're getting back to the post-COVID lows here. So 21st of September 2020, go check out perhaps the weekly chart, and that low there at 179, I do think is going to be key low, and it could be influential in maybe seeing a bit of a turnaround here. And you've got a decent round number there at 2. So this is a contract you can trade with ThinkMarkets. It's our natural gas contract. And I would say if you saw some big white candles come in around 2. If you saw some long lower shadows on candles come in around 2, I think you've got a pretty decent reward to risk trade in terms of wherever the bottom of those white candles / lower shadows are, that's your stop loss. And it is a super kamikaze speculative buy here for a swing low. And then, you're targeting potentially Fibonacci retracements back up, or at least say 360. So it's understand that these types of trades are super risky because you are trying to find that low. But I would say don't just blindly buy at 2 or a 179. At least wait for some white candles or lower shadows first to indicate that the market is trying to pick the low there. Don't remember what you're trying to do. See if the market agrees. I threw uranium in this week simply because what normally happens when crude oil prices and natural gas prices get whacked is uranium prices go down because uranium is this great alternative to those fossil fuel related commodities, and it hasn't. That's really interesting. It's actually turned up. We've seen a bunch of uranium stocks on the Aussie market actually turn up as well. I wouldn't say they're looking half interesting. Aura Energy, ticker code AE, is still my favorite in that sector, but it's very encouraging to see uranium prices trend up despite what's happening in that broader energy space. Okay, let's have a look at the forex now. US dollar index rallying Thursday, Friday. Didn't see a lot of data on Thursday to suggest the rally, but I do think maybe there were some whisper numbers out there on what the non-farm payrolls were going to do. So traders positioning ahead of that Friday report where we saw the US dollar really take off. And I think a lot of traders are on the wrong side of this trade now. We'll look at the Aussie dollar in a second. Gold, another example of traders positioning for a trend and then this sharp reversal occurs. I think we could see 105 here. I think that's a big possibility. And what that means for the Aussie dollar is you could see 67 on an overshoot potentially before we do see that area where many lows have been set in the recent past around 66.86, 66.26. Kick back in as an area of support. Again, you blend these two black candles, it's not great for this trend. So a lot of traders on the wrong side of that. And honestly, I did not see that coming. I would have said again on Wednesday here, it was looking great for a move into 73. Aussie bonds are a little bit boring. They are trending lower, in line, I guess, with this feeling that the Reserve Bank is one of the more dovish central banks out there. But we'll probably react to the upside when they trade again today, because we did see that huge leap in both short term here on the 2 years and then on the 10 years in US yields. Still moderate in comparison to how much they've fallen over the last 4 or 5 months. If you look at the move here from, say, late October, this is corresponding with the huge rallies in many risk markets all around the world. Okay, so that potentially jeopardizes, probably why the NASDAQ did flame out towards the end of the session, potentially jeopardizes this fledgling move higher. So in investors, you should be watching this chart with great interest and potentially great trepidation as well. We don't want to see this rocket higher to keep stocks moving up. Looking at the yield curve, what we're looking for here is sort of where it is in relation to, say, a month ago. Is it going higher or lower? It has headed back up from, say, a week ago, but lower than a month ago. But it is still very steep, which is disturbing in terms of what it could indicate for a potential recession down the track when yield curves are sloping from top left to bottom right. That usually is a strong indication of weaker economies down the track. Not so much weaker for the January KSIN and official reversal of their right to left PMIs. They showed a significant bounce back, actually. We even saw the services move back into expansion on the officials. Just a slight miss there in terms of expansion on the manufacturing. So anything above 50 is expansion. And look at the officials. They were much better. Both sectors showing expansion and substantial improvement from their previous readings. So some good signs there on the Chinese economy. Also helpful for the US economy and Chinese economy and everywhere else is the fact that this man here, Jerome Powell, uttered the D word, not deflation, not prices going down, but disinflation. So prices are still going up, but they're going up at a slower rate of increase, if you get what I mean. So interesting, he used that word. Markets rallied, I think even on that word. He confirmed that probably 2 more 25 basis point rate hikes are what we're going to get. I think markets were already ready for that. He started to mention this idea that those rate hikes would be data dependent though, and that is really softening some of his language there. So we're talking about a couple more rate hikes to get that level is sufficiently restrictive. We're going to be very cautious about declaring victory and sending signals that we think the game is won. But the market took the signal as the game is won anyway. Non-farm payrolls, there's the outlier. That's the January number. What a monster there, 517,000 jobs. We were expecting 178. So you can see why markets reacted so strongly. Potentially an outlier, though, because the Labor Department made a bunch of changes to the way they classify certain parts of the labour force, just as an annual review that they do. So February, I think, is going to be the key number to see if many of those jobs stick. There was some seasonally warmer weather as well. That also helps hiring. But otherwise, look, it was a strong report. Plenty of jobs being created in your hospitality areas as well. Unemployment rate is at 3.4%, and that is the lowest since 1969, apparently. That's a major number there. Looking at local retail sales, as strong as that US data was, Aussie data looking quite weak, with December retail sales down nearly 4%. Of course, that's the key Christmas spending period. However, the data suggests also that much of that Christmas spending was probably dragged forward into November. You can see how that November print was, let's face it, a bit of an outlier as well. So let's not, again, throw the baby out with the bathwater just yet. Let's bring everything close to home here. Have a look at the market. We continue to grind higher, don't we? There's not enough bad stuff out there to pull us back on any day. And we always find a sector to push us up. And this week, healthcare and technology were the sectors that benefited at the expense of sectors which had pushed us higher in the last few weeks, like gold and materials. Property also had a massive bounce back. Discretionary still doing very, very well. Financials lagging behind, but again, financials have been pushing us up to this point. So we're seeing this sort of rotation in the market from sectors that have done so well into sectors that through 2022 hadn't done well. Your worst hits in 2022. Information technology, discretionary, and property. No coincidence that they are the best ones today. And there are probably still legs in that rotation. I think you can continue to target those 2022 dogs and sell some of those 2022 darlings. Looking at the market breadth, we are very close to bull market territory here. We're talking about the number of stocks trading above their respective exponential moving averages. So 5 periods would be 1 week. How many stocks in the ASX 300 are trading above their 1 week trends? Okay, this is going to be a little bit volatile as markets pop, markets pull back. Okay, let's have a look at the longer term trends. 231 periods are getting pretty close to a year there, and it's the slower moving average in my trend ribbon. Okay, so what we're looking at here is how many stocks trading above my long-term trend ribbon, and we're over 60% now, and that is significant because when we get to that 2/3 to 70% level, that is bull market stuff. That's where the best bull markets have occurred. You can see how this is really flattening it out now along the curve, and also substantially better than last week as well. So that is a super bullish sign for Aussie equities. Other super bullish sign is the fact that so many short-term trends prevail at the moment. We know why energy is going down. We saw that huge fall last week. Even some of those long-term trends that have been down for so long in your discretionaries, your 2022 dogs, your information technology and properties, those are really close to changing. Almost went up on at least a couple of those today. So again, I think you can stick with those. Have a look at where the value lies in the Australian market. We're getting pretty close to fair value. Long term, 15 is what we say is fair value for the ASX. Long term, we say 10 is cheap and 20 is expensive. You can see, no coincidence, that peak since COVID, when we moved to all-time highs, the market was at a 1-year forward PE, and these are Thomson Reuters estimates here of 20. No surprise. We got to 13.6 just as we started 2023, where some of those indices like technology were looking very, very cheap. Property was looking extremely cheap. You see how they've bounced back now. So there were bargains there in property. I've been saying it in these sessions, to be fair, but we're seeing 1-year 4Ps and some of those sectors move back up, but still on a relative basis compared to, say, something like healthcare, which is crazy expensive. I'd suggest they are still looking cheap. The interesting ones, obviously, materials. We have said that this was going to happen. If you go back and review the tapes on these sessions from 12 months ago, this was sort of 6 or 7. I did say, hey, look, they are going to rise. They're going to move back to their long-term norms, and they are doing that. So materials are getting back to, roughly pre-COVID long-term average there, and energy probably still has some to go. Okay, looking at the week ahead, the RBA interest rate decision, that'll be tomorrow. Looking for a 25 basis point hike. It's baked in. It'll be all about the commentary though, because we have had some really hot inflation data since that last meeting, and that could throw a bit of a spanner in the works for the local market. My hunch is any commentary we get, I think our local Reserve Bank is one of the more dovish central banks out there, and I think that will continue. Jerome Powell speaking on Wednesday, that'll be 4 a.m. Sydney time, in what is a relatively quiet week. I know there's a few reds in there, but nothing so sinister out there. I think will move the markets massively one way or the other, at least not like last week's non-farm payrolls. Watching out for US consumer sentiment data at the end of the week. Okay, Ask the Experts back on tomorrow. That link is where you go to register. So come and join me at 1 p.m. Sydney time tomorrow. Bring your portfolio along and I will give you a technical and fundamental reader on your favorite shares. If you're not a client of ThinkMarkets, you really should be. We've got all the shares and ETFs you need to trade for your self-managed super fund, but we also have CFDs on all of the major markets. So any of those major indices we talked about today, you can trade with a CFD long or short. Most of the commodities we talked about today, and certainly each of those FX pairs, even some of those bond markets as well. Market leading spreads and commission free on shares. We are an award-winning broker. We keep winning them, and we were just nominated for another one in the UK very recently, and that's for a good reason. We've got the best platforms, the best supports, the best product offering, and the best commission. If you like what you saw today, hit the subscribe button to stay notified of any of my future updates, and please hit the like button to let me know you like what I'm doing so I continue to do more of it. Apart from that, it's been a pleasure chatting with you today. All the best if you're trading, investing. To catch up again. Bye-bye for now.